Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi. This is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, David Morehead, Chief Investment Officer of Baylor University, will be our guest. So listeners have a high-level sense of our roadmap for today. We'll start with some background, then the usual. Investors and business leaders should be able to extract a great deal of value from David's insight. On that note, welcome, David.
Thanks. Happy to be here.
Great to have you. Why don't you start with your background?
Sure. I grew up, lived, worked, went to school in the Chicago area, moved down to Texas about 15 years ago to take a job here with the Baylor Endowment. But prior to that, I spent about 20 years on the direct investing, direct trading side. So I haven't traded metals or softs like the ags. But I have traded most everything else in the marketable space. And that was my focus here upon moving to Baylor, is overseeing the marketable side of the portfolio. And then 5-6 years ago, when the prior CIO retired, I moved into this seat. So I oversee the portfolio here. I still concentrate on the marketable side, and my colleague Renee handles everything on the private side.
Got it. And to level set, how are you defining marketable?
Good question. So in our book, the categories are fixed income, equities, and then marketable alternatives. Marketable alternatives could include hedge funds. It could include short-dated private investments. If it's a long-term drawdown vehicle that is expressly on the private side of the house. And so that's what Renee oversees.
Got it. And what's the objective for the portfolio? I have a sense, but for listeners and maybe I'm wrong.
Yeah, no, it's interesting. It's changed over time. And I think that obviously for listeners, that's sort of a key point to understand as it relates to endowments. Organizations change and adapt, and the needs and goals of the organization change over time. And so the portfolio has to do the same thing as well. So when I first got here, I first got here in early 2011. And so that was coming off the back of the global financial crisis. And the real need for the portfolio at that time was to stabilize things. It hadn't been a particularly good set of years, as you can imagine, over the prior 2-3 years. And so the focus at that time, probably for the first 3 or 4 years, was really attending to the downside, addressing some of the strategies and portfolio structure that had existed kind of through the financial crisis up until that time. And then over the next 4 or 5 years, it was really about building a foundation for what we wanted to do going forward. And so I would say, the first real private investment, sort of like re-engagement for the portfolio, kind of occurred in 2013, 2014. So coming out of the financial crisis, for example, there had basically been, no new private investment allocations made for 2010, 2011, 2012. So 2013, 2014 is sort of when the portfolio re-engaged on the private side of things. And then I would say the last 5 years, as the university has kind of attained R1 status as far as a research university. There's been more effort or push on the research side. There's been more of an interest in increasing applicants on the graduate side while keeping undergraduate enrollment constant. And so really over the last 5, 6 years, the focus has been on we have the foundations of return generation in place. Now we really want to try to step on the gas and do better for sort of the top line, supporting the university, et cetera. So it's important for listeners to understand that just as organizations change, as a portfolio, we're only a service provider to the organization that we serve. And so we also then have to change and adapt to what the organization is doing and going through. And so that's kind of the history of the endowment over the last 15 years is sort of, playing defense, level setting everything, developing a foundation, and then over the last 5, 6 years has been setting things in place to really try to drive upside returns so that we can help support the university in a more meaningful way going forward.
And again, I have a suspicion in terms of the target returns, but each, it's like the old joke, you've seen one endowment, you've seen one endowment. What is the target return?
Yeah, so we don't actually have target returns. We think that if you do have a target return and if it is something that you're trying to attain on an annual basis, you kind of necessarily are taking risk at the wrong time. And so I would say, over the first 5 years, it was really like, do not lose money. Over the second 5 years, it was more along the lines of produce average returns to peers. And then over the last 5, 6 years, it has been kind of accelerate things. If we had an internal goal, who knows if we'll reach it, but if we had an internal goal, it would be along the lines of let's try to double the endowment every 5 years. If you do the math on that, that kind of backs into a 15% annualized return, not annual return, but annualized. And obviously that's like a heroic type goal. I don't know that anyone's particularly done that for any significant period of time. So you can sort of see the change in sort of like objective from like a return perspective over that 15 years. It really has changed in terms of like what we're aiming for. And that then of course means that the underlying things that are in the portfolio have to change as well.
And this podcast, is about innovation. How are you innovating to improve alpha from a manager decision-making perspective?
Yeah, so that's a very interesting point. And I think innovating on portfolio structure is something that I think the industry at large would benefit from thinking more deeply about. Historically, the endowment space, and not just for universities, but libraries, hospitals, pensions, et cetera, has largely been we're going to outsource our strategies and our allocations to the best managers in the world based on what we see and research and investigate, and we're going to stop there. And I think that there is a benefit to diversifying beyond just manager allocation. That's largely where the entire industry stands right now. But I think just like there's diversification by strategy in the underlying book, or if a listener has their own portfolios, diversification across either stocks or bonds or individual names, something like that. I think within the endowment space, there's also maybe like an increasing effort to diversify in terms of like how alpha is created. And so here we kind of think about it a couple of different ways. There's certainly the manager allocation bit, and you want to try to do that well. There's also the allocation bit from a tactical perspective in terms of like when you allocate to a manager and when you deallocate from a manager and then give that capital to someone else, right? It's not necessarily the case that the best time to give capital to capital structure arbitrage strategy, for example, is the same best time to give capital to a high yield strategy, for example. And so, as opposed to looking at like the return, the backwards looking optimal asset allocation model and saying, well, over the last 20 years, the allocation model that best would have worked over that last 20 years is, a 6% allocation to high yield. Therefore, we're going to give high yield a 6% allocation at all times forever. Our perspective is there are particular times when high yield or convertible arbitrage or risk arb or long only, there are particular times when those are more in favor and more out of favor. And so we'll try to take advantage of that. And that's a second sort of layer of alpha, if you will, beyond the individual manager. So you have individual managers who can do a really good job, and maybe they can make 1 to 300 basis points over their benchmark or index. And then if you are particularly good at the allocation front within that strategy, maybe you can add another 1 to 300 basis points to that. And then what we've done more recently, and it sort of dovetails with what we're trying to do over the last 5 years, is we've basically taken 10 to 15% of the portfolio and said, what we need to do for the university is really grow the corpus of this endowment. And so we're going to take 10 to 15% and we're going to allocate it to very highly convex investments or strategies where we're trying to turn, say, $10 million into $100 million. Obviously, if you could do that and have no losses, obviously that's a huge win to the portfolio and a return boosting exercise, et cetera. And so that, I think, is potentially a third way to generate alpha, if you will, to the portfolio. And it's something that we're kind of in nascent stages of. The early returns, early results from that have been positive, but of course, we need to wait a little bit longer than the 2-3 years that we've been doing it to actually say, this is like a great thing and more people should do this. So those are kind of like the 3 different ways that we think about diversifying, what we are doing to try to generate alpha. And of course, I think historically, the endowment space has always been focused on the manager selection bit. And the answer basically is like, if you do that really well, you can outperform your benchmark or index by 200 to 300 basis points. What we're looking to do or seeking, noodling around, trying, is if we can do the allocation bit, I think you can add another 200 to 300 basis points. And if you can do this convexity bit, I think you can add another 200 to 300 basis points on top of what historically has been the case. So to your point, as it relates to innovation, I think it's really important for teams or organizations to think about what can we do, not within what strategies can we add, because that's kind of within the manager selection category, but what other methodologies or what other capabilities can we bring to the portfolio to try to create returns on top of what we're already doing. I think this is a very important thing for the industry to think through and grapple with and really try to innovate, because ultimately all of these portfolios, whether it's for a library or a hospital or a pension or a university, et cetera, et cetera, et cetera, all of these portfolios are for social good, right? Like we're helping students go to school who wouldn't be able to go to school other ways. But I have friends who are running hospital portfolios and they're clearly helping sick children. And that's equally as important. Pension, they're helping pensioners in their retirement years be able to live life, et cetera. So I do think it's very important, and podcast and what it's about is very important as it relates to the endowment space in general and trying to do better for society.
Can you give me or us rather, an example of one of those convex situations?
Sure. This one is particularly timely. We've been working on it for the last couple of years, but we own a data center development company. And everybody knows what data centers are and how they work, et cetera. The issue has been is that historically data centers were sold or created or erected on land. And so the deal was, did you own the land that was closest to the end place, particularly if it's a cloud-based data center, where the data was going to be used? Now, because power is in short supply, its data center sites are really sold on a per megawatt basis, not on a per acre basis like they used to. And so, we, along with our manager, have acquired sort of 6-7 gigawatts of power. And really what we're trying to do, we have several different managers where we've developed funds of one. And what we're trying to do in those portfolios is address the convexity of the underlying investment. And one of the ways to do that is look for categories where there's significant demand growth. And then within that, what are the bottlenecks or supply impediments to that demand growth? And then trying to go own those bottlenecks in advance of course, the rest of the world, rest of the industry, figuring out what those are. So another example would be marinas, for example, right? As the world gets wealthier people buy boats. And it's a little bit of a pain in the neck to have the boat in your driveway when you want to use it. And so slips are at a premium. The difficulty, of course, is that if there's not already a marina on either the ocean front or the lakefront, it's really hard to create a new one. You either have the Army Corps of Engineers involved, or you're having to create a marina out of oceanfront property, which obviously would be the most expensive way to do that, because you'd have to go around and buy $20 million houses and then turn it into something as mundane as a marina. So like that doesn't work, right? So the supply impediment is the marina itself. The demand growth is capital, wealth, boating in general. And so if you run around and own marinas, the compounding of capital, both in the markets and over time, obviously leads to wealthier people. We have more millionaires now than we had 20 years ago. We'll have more millionaires in 20 years than we have today. People have a propensity to spend their money as opposed to just sit on it. And so marina space and therefore slip prices will continue to go up over time. So those are two examples of things where there's a lot of demand, there's a supply shortage or bottleneck somewhere. And if you go own that bottleneck and the demand continues, that of course is the bet. But if the demand continues, then 5 or 10 years from now, you can kind of name your price. And that covers over a host of mistakes that we can make in the investment process, because of course we're only right 55% of the time. And so if we can get in front of a big tailwind, that really helps us in terms of being more sure about go forward returns and overcoming any of the kind of like idiosyncratic things that occur in the world from time to time.
That's a good segue into, aside perhaps from just the convex or overtly or extremely convex, where else do you think the opportunity set is interesting today or now or in the near term?
Yeah, I mean, it changes, and everybody's sourcing bit is a little bit different. And so I'll just opine a little bit on what we've seen over the last year. I would say that maybe a year ago until about 4 or 5 months ago, a lot of what we were seeing was real estate oriented, right? Marinas is one of those things. It's a real estate play ultimately. Data centers is another real estate play. More recently, what we have seen, or the things that are kind of coming across the transom that are interesting, are healthcare related. And that's interesting because, of course, healthcare biotech has been weak for some number of years until the last month or so, last 2 months, 3 months maybe. And so it's interesting to me to see what interesting investments are kind of coming across our desk, because it does give a little bit of a window into where the broader market is. And obviously, if somebody is trying to raise money in the healthcare space, there are a whole bunch of places to go outside of us, right? There are all sorts of biotech managers, healthcare managers, et cetera. But if the space is under a lot of pressure and those external managers are having a tough time raising money, and there's still innovation and development in the healthcare space, then some of those things end up coming across our desk. And so I do think it's interesting that we have seen less on the real estate bit. We have had interest rates come down a little bit. We expect interest rates will come down a little bit further. Obviously, that's supportive of the real estate industry. And so it's not surprising, I suppose, that some of the angst that existed in the real estate, there's more of this back to office going on now than there was 2 years ago. And so I guess it's not surprising that some of the angst, or we need money and we don't know where to get it, on the real estate side has kind of gone away to some degree. And what we're seeing kind of in its place is healthcare, which is sort of still in that angsty moment. There still hasn't been a ton of investment and allocation in healthcare like there was 5 years ago. That industry has kind of had a swoon here. And so it's kind of interesting that we tend to see the bits from the industries that are most having a difficult time, or have been having a difficult time for a couple of years.
Got it. And what's the biggest challenge in achieving your investment goals?
I mean, I think right now we're really trying to double, triple, quadruple the endowment for the benefit of the school, is to not reach. And I think that that is an important bit for kind of like all investors, particularly endowment related investors. When you reach, it can seem good today, but almost definitively that comes back to haunt you when things turn lower. And so we have to keep at the front of our mind, despite the fact that we have this objective of like trying to take, we're 10% of Baylor's budget right now. A lot of the schools in the Northeast are 30, 40, 50% of their university's budget. We would like to be able to help and support Baylor in that manner. I always joke, like, I would swap returns for AUM in a heartbeat, because ultimately students need dollars, not returns. And so having a larger endowment is like the hashtag winning, not necessarily having the best returns. Having the best returns can help you get to having a bigger pile of money, but it's having the bigger pile of money that's really beneficial to the school. And so despite the fact that we're aiming for and going after that, I think you still first have to keep in mind sort of risk adjusted returns, and think about, because we don't want to go backwards, right? If we're reaching, the market turns lower, all of those things that we quote unquote reached on, they're going to go down more than the general market. And so we don't want to be putting up negative returns in that environment, because that, of course, is counter to the goal or objective that we're trying to achieve. And so the tension for us is trying to truncate the left tail in all scenarios, but then trying to drive upside returns. And that's why we've kind of are playing around with this convexity idea, because of course, if you could do that, that kind of solves both issues, right? You don't actually take a lot of risk putting those positions on, and then they pay off big. So that's what we're trying to do, but it's almost like you have to have two objectives. When you're looking at something, you have to be like could this be 5 or 10x higher? And at the same time, could it go to zero? And so not a lot of things, as you can imagine, kind of make it through that filter of achieving both of those objectives. So that for us currently, with where the portfolio sits and what we're trying to do, is kind of like the biggest hurdle.
And just remind listeners, how large is the portfolio?
Yeah, the Baylor Endowment portfolio is about 2.4 billion today. So yeah, what we're trying to do is get it to 5 and then get it to 10. If we can do that, then, instead of giving the school $100 million a year, at 10 billion, then we're giving the school $4 billion, or $400 million a year. So obviously that would really matter. We're 10% of the budget now, giving them $100 million. If we can double it in 5 years and then double it again, then we'd be giving the school $400 million, 10 years from now. That would make a significant difference and impact to the university and scholarships, et cetera.
Yeah, that's for sure. What's a red flag with a manager or someone that you invest with that would cause you to either reevaluate or divest or not invest?
Yeah, so for us, the subjective side is very important. We would often say internally that if we have questions about an individual's character, we don't care what the returns are associated with that. So character integrity matters to us. Another way of putting it is, if things go wrong, we want to get our money back. We don't want to be in court trying to get our money back. And so if there's any sort of whiff of not doing the right thing, we're out as far as managers go. We view the partnership as truly a partnership. Partnerships exist through good times and bad. And so if there's a manager where there's some question about whether, who they're going to be in the difficult times, that's like a hard no for us. In almost all endowment cases, there's a lot of quantitative work that's done in terms of returns and whether it holds up versus the index, if those returns are coming simply because of leverage, or if the manager is doing something particularly unique or special that is repeatable and enables returns to happen across time and space. All of that is stuff that is done across the industry. And we ask for references from the manager's neighbor. We ask for references from the manager's college roommate. We ask for references from somebody outside of the industry who has known the manager for 20 years, et cetera, et cetera. We're trying in all of that is to triangulate into who that person is. And I guess my view is like, if so-and-so is cursing at their neighbor when they're taking out the trash, maybe I don't want to be invested with that person. And so that's what we're trying to get at or have an idea around on the qualitative side. And we really spend a lot of time there.
Got it. And what's a material mistake you've made investing and a lesson learned from it?
Yeah, there have been There have been two that are top of mind to me. There was one time where I mistook purity for humility in a manager. So in general, we like humility because the market, of course, kind of kneecaps you anytime you think that you've got the tiger by the tail. So if you're kind of going around with your chest puffed out and you're like, I've got this all figured out, that's almost exactly when the market like gives you a whipping. So we like humility. And in this particular case, I viewed the manager as being humble when the reality was that the manager was insecure. And insecurity, of course, leads to a very fragile organization, tends to be a little bit narcissistic because the person is concerned about their own value, how they appear to others, etc. They tend not to share economics. They tend not to invest in the business because they don't know if it's going to be around forever. So everything tends to be about me. And we've all been in organizations when the leader is all about me, and that's not a fun place to be. So it leads to pretty fragile organizations. And in this business, there are always going to be downtimes, right? No, there's no manager anywhere who has always been in the top 10%. I think there are some great academic studies that all of the managers who are in the top decile of their category or whatever have spent time in the bottom decile as well. And so we know that that bottom decile performance is going to occur from time to time. And if you have a fragile organization, then it often can't withstand those periods of time when things are not going right. And so that was a mistake on my part. That organization did end up coming apart and going away. We ended up making money in that situation, but of course, we would like to make money and then keep making money. And so that was a mistake. And we now have questions around it to try to suss that out. So we have questions around like how far in the organization does equity get pushed down? We have questions around like what are you doing today to prepare and invest in the organization for as it relates to the years to come? Like what percent of revenue are you setting aside to invest in the organization going forward? So there are questions that you can ask around to get at whether the individual is insecure, it's all about me, or if they are bringing people together, they're viewing others as equally important, etc. The other mistake that I've made was a manager, again, very, very good character, very, very good guy, almost too much of a good guy. And there was not enough of saying no within his own organization. And that led to some problems internally. Eventually, that organization came apart. And so I think those are two examples on either side of a strong, healthy organization. You can either have somebody that's too dictatorial, where it's all about me, and that creates a fragile organization. Or you can have somebody that's too friendly and can't say no, and a lot of conflict exists in that organization. That also leads to a fragile organization. So in both cases, in the one case we made money, in the other case we lost money, but the errors were related to like those qualitative questions around the organization. And so those are both kind of front and center of my head when I'm talking to managers. And it ends up being the case that you ask deeper questions. You ask more questions around the margins because you're trying to get to, I want you to be a good leader that people look up to. But part of being a good leader means that you have to say no, and you have to say no a fair amount of time. So like, that's not what we're doing. That's not where we're going. That's not what we're investing in. But at the same time, you don't have to be mean when you're saying that. And so it's that middle ground. And I think we all know the value of good leaders, and we all know the trouble that occurs when you have somebody that's either letting conflict fester or is acting like a dictator, and neither of those situations are good.
Shifting gears, inflation is something that has oscillated while over the years we've been doing this podcast, and it's, I think, highly relevant. Again, curious to hear your thoughts on it and or how it impacts your portfolio construction or investing, if at all.
I will say this, it doesn't impact it much. When inflation was sort of like 8%, we were not in the camp that it was going to stay high forever. So we actually didn't change very much. One thing that I think that we do consider as it relates to portfolio construction is that we have a lot of equity in the book. Like right now, we don't actually have any credit. Credit spreads are too tight in my view, and also to the inflation point, it doesn't particularly work very well if you have a lot of fixed income in an inflationary environment. And so we've been strongly on the equity front. We're currently starting to pull back on public market equity. Some of these convex things, obviously, there's still equity. There's still a supply demand feature. That supply demand feature doesn't go away depending on what inflation does. And so we're still allocating to those types of things. But where valuations might be stretched in public markets, we are starting to rein things in. But that's really the first time in, my gosh, since 2021. 2021 was the rebound from, the pandemic, and we did take chips off the table in sort of fourth quarter of 21, and then redeployed those chips in June to October of 22 as tech valuation sagged in that environment. But since then, we've been pretty much all equity all the time. And obviously that helps in an inflationary environment. So we're not doing anything specifically like inflation is 3% now, and I think it might go to 5. That doesn't concern me a great deal. If you said, inflation is 3 and it might go to 10, that's a different story. But I don't think that there are a lot of people who think that's going to happen. So we do indirectly think about inflation as it relates to the portfolio construction of the book, but we haven't been concerned about the late 70s type environment continuing for a significant period of time. And so we haven't specifically structured the portfolio to get around something like that.
And what is a piece of advice you have for other investors or allocators? Could be related to something you've learned along the way.
Well, the first thing, obviously, is to stay humble and keep learning. I change jobs fairly frequently, and sort of like my first 20 years out of school, I think over that period of time, I might have had 6 different jobs. And so I think the longest period of time that I was in I'm trying to think. I think the longest period of time that I was in any particular role over that period of time may have been 4 or 5 years. And so there was some thought in the back of my head, like you see coaches, like I always use this example, like Mike Krzyzewski is obviously coached Duke for 30 plus years. And I'd always be watching Duke like in the Final Four, and I'd be like, my gosh, when you're in your 29th year of doing the same thing, like how much better are you than the 28th year or the 27th year? And so to me, it just watching, it seemed like a little dubious as to like how much better one could be. You've been doing it, that long for such a long period of time. Is like, hadn't you learned everything, by the 25th year, say? And so like 26, 27, 28, 29, you're like the marginal benefit that you're able to apply to either the game or the players is actually not that not that significant. So it's been interesting for me to then be here in this role for the last 15 years with Baylor. And it turns out, at least in this industry, that there's an immense amount that you can learn and develop even when you're like me, when you're 30 years into an investing career. So, as I've thought about it and described it to the younger folks in our office, I would say I think I'm like twice as good now as I was 7 years ago. And so, we kind of relate that to, the younger analysts in our firm. Like, if I can distill and like give you the color, the data, the perspective, somehow the experience of what I've learned and whatever, over your first 5 years here in our office, then you can double and compound, like, and by the time you get to be my age, you'll be like, miles ahead of where I'm at. And so it's been really interesting to me to see that in our industry, it's really possible if you're attentive to it and you're not just like going to conferences for like handshakes and drinks. If if you are really like on it, trying to learn and grow and develop, the there's so much to learn in the different sectors, or how the economy moves, or new technology, et cetera. There's so much to learn in our industry that you actually can be significantly better even though you've been in the industry for a long period of time. And so I always talk to our younger analysts, and I'm like really impressing that on them. Like, if you care and you're focused and you're really trying to learn every day that you're here, that you come in, even if you're not here, if you're somewhere else, et cetera, the benefit to you is immense. And I think in some ways it's particular to our industry, because in our industry, you can take the entire portfolio down to zero and build it back up in a different way. So if and as you learn, you don't have particular strictures or structures that you have to necessarily adhere to, sort of like a basketball game, right? Like, the basketball playing court and the height of the baskets has not changed ever, right? So everything has to happen within that realm. But, some of the things that we've talked about earlier in this podcast, like, those are new things that we're doing that we didn't do before, right? And they weren't even things that were in my mind to consider doing 15 years ago. And so I think the benefit of this industry is that there aren't hard lines as it relates to, say, like the basketball court. There aren't hard lines in terms of like the hoop has to be 10 feet tall. And so because you can like break it down and then rebuild it up, there's massive gains to continuing to learn, develop, think outside the box, and then execute on some of those things. And I guess what we try to do here is we try to fail fast and fail small, right? So if we have a new idea, we can put, say, $1 million behind it, try it. If it doesn't work out, that doesn't affect the portfolio very much. If it does work out, though, you can scale that up and then have a meaningful impact on returns going forward, at least until such time that everyone else figures it out as well and then is doing it. But even in that case, yeah, your competition versus your peers, up or down the road might change, but it would still be the case that collectively y'all are benefiting society more significantly than you were previously. And so I think the humility thing, saying like, I don't have all the answers, is the starting point. And then the desire or care to try to know the rest of the answers drives sort of the learning, and then the ability to think outside the box and develop something that might be new or beneficial for the portfolio and organization.
Anything we haven't, we're almost out of time. Anything we haven't discussed that we should have, or that you think is important, worth mentioning in the context of investing, or for other investors or allocators at the moment, or at this time, I should say?
Yeah, I mean, we've covered a lot of ground. I'll offer something else that I had not thought through it completely, and did end up causing me some difficulty. So a lot of let's just take universities. It could apply to other endowment related organizations, but there are a lot of universities that don't exist in Palo Alto or Boston or Chicago or Dallas, that don't, like, we're located in Waco. Waco is 150,000 people, and it's 100 miles from Dallas. It's 100 miles from Austin. So UT is in Austin, right? That's an attractive place for young professionals to live, grow, develop, etc. There are a lot of universities that exist in places like Waco, where it is more difficult to attract mid-career professionals. So what we have done, and what a lot of other schools do, Notre Dame is sort of famous for having an office filled with Notre Dame grads. And we've done the same thing, because if somebody is choosing South Bend or Waco, you're sort of more sure that they're going to choose those places if they have already chosen them as an undergraduate student. And so we have done that. The mistake, or the thing that I didn't really think through, is that when you are developing it from the ground up, it's going to take 5 to 7 years for those newer analysts to grow, develop such that they can be really helpful or impactful to the portfolio, or what we're doing on the investment side of things. And during that time, I am going to be the one that is going to be mentoring all of them. And so I've talked about this before on LinkedIn. About a year ago, say 6 months ago, a year to 6 months ago, I was really dealing with sort of like a burnout situation, because for the past 5 years, not only am I trying to shepherd the portfolio and do all the things that are associated with that, but then spending a lot of time mentoring basically everyone in our office, because we tend to have a young office. That improves over time, of course, as the individuals mature, develop, get better, and are better able to contribute in meaningful ways. But if you are starting out with a bunch of undergraduate students, it can be a very, very difficult mountain to climb. So that was something that I didn't totally take into account, and sort of came back around, kicked me in the tail a little bit. So I just offer that for newer CIOs, or CIOs who are moving to a place where the school's undergraduates is sort of like the obvious place to look for talent. You do have to keep that bit in mind. And it was just a mistake of not having gone through it, not completely thinking through it. But if I can help somebody else avoid that mistake, that would be beneficial.
Great. Well, David, we'd like to thank you for that interesting discussion and sharing your most valuable asset with us, your time, apropos what you just said. We hope listeners have a better appreciation for what one of our more thoughtful allocators is thinking about, and how we may all benefit from it as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.